we are giving some time to people
to enter.
Of course.
enter the room.
The academic 5 minutes, right?
Now in Italy, 15.
15. Okay.
15 minutes. I swear. In class
It's
is
like-
15.
You know, in Greece, when you have meetings, it's probably like half an hour, 1 hour. It's very flexible.
Well,
It's-
usually it's 15, not in Bocconi, however. Bocconi, you should be there, sharp,
Exactly.
perfect.
Okay. You see, distinguished people. Okay, should we wait another 30 seconds and then we start? Okay. So, welcome everybody to the third of our webinars organized by the Research and Policy Network European Economic Policy, Laura Bottazzi there, and me, Giancarlo Corsetti, as coordinators and moderators of the seminars. So today we are very happy and lucky to have Marios Angeletos talking maybe technically on a question that jokingly we define the everyday questions, especially not only Europe at this point, but also overseas. Can deficit finance themselves? This is a question that I think Mario will be very explicit, also very accurate in defining all the aspects of theory that you must lay down to address this question. But for a policy perspective, the aspect of theory that you lay down are also a checklist, a pilot checklist of things that are relevant in assessing different policy alternatives. And we were reminding ourselves of the old times of the static multiplier, in which to finance deficit with taxes, you would need a very large multiplier, like spending by a multiplier of 2.5 and a very large tax rate to sort of collect the extra revenue from extra output, let's say 0.4. Now, those numbers, fiscal multiplier of 2.5 and a tax rate of 40 are a little bit off, but they give you a little bit the idea of the dimension that may be the quantitative dimension that is relevant in assessing how much of the spending or tax reforms may be sort of taken care automatically by the endogenous response of the economy. Clearly, as you see, Marios will bring in many more aspects than the static multiplier. There is a dynamic, there is inflation, and there are other aspects that will make this, hopefully, these seminars interesting. One last thing, maybe later we'll discuss a property of this model, which is the symmetry, which is, as taxes, as deficit finance themselves, austerity or cuts may be self-defeating in the sense that not having a substantial effect on the debt to deficit ratio. But I will postpone this in the discussion and just look at the theory of what we can learn from theory. So I think I've been too long, but it's all yours. We have we'll keep it about 1 hour, including the question and answer that you are invited to write in. There is a question and answer function in your screen. Please send us your question and answer, and we'll convey them to Marios. Laura, unless you have something else to add.
No, it's perfect. Just how long are we going to do? We're going to do the presentation for 30 minutes, then ask a question or longer. Let's concentrate on the length of the presentation.
I think it's up to Marios. I think
yeah, exactly. I was asking Mario. Go.
I was thinking like 40 minutes.
Okay,
given what
perfect.
you're talking, but
Okay, that would be perfect. That would
but
be
you know,
perfect.
I'm Greek. I may default and go to 2 hours. We'll see.
No, no, no.
You
It's
won't
a
let
long
me.
run. It's a longer effect.
I'm kidding.
No. That would be perfect. And then, yes, right. And if it's a question that you really want to, you need to answer immediately, I'm gonna gonna read and directly to you. Okay. So please go ahead.
Very good. Thank you, Giancarlo and Laura, for having me. Two quick introductory remarks. One is Giancarlo mentioned about the Keynesian cross and static Keynesian logic. I think there was actually a lot of wisdom in these simpler models we had before. It was a little bit lost in the textbook new Keynesian model, and it's re-emerging with the recent heterogeneous changes in new Keynesian models. And you'll see a version basically of that, of how that wisdom is still there in our model. And the second thing is, you know, I felt extremely uncomfortable when I went and presented this paper in Greece, you know, telling my compatriots how they can run deficits and they can finance themselves, given my history. You know, Italy is not exactly the same, but I'm still
But still in the same.
But never mind, I will ignore that, okay? So this paper is joined with Chen Liang from Berkeley and Christian Wolf from MIT. Two amazing young guys. And so let me start. So here's the question. I want you to think about the government running a deficit today. I'm not going to tell you for what reason, maybe to try to stimulate the economy, finance government spending, finance a lump sum transfer, a stimulus check. Okay? And we're in an economy where real interest rates are higher than the growth rate of the economy, so there's no free lunch. Okay? Debt is costly. And the question is, if you run the deficit today, how you're going to pay for the deficit? And two traditional answers are the following. The first is fiscal adjustment. If you think about neoclassical models, what Robert Barrow, my advisor, and others thought is you run a deficit today, you need to pay with surpluses in the future. So you need tax hikes in the future or spending cuts to consolidate the government and pay for the accumulated deficit. An alternative is monetary accommodation. Maybe the old-fashioned version of that is you just print money and you use seniorage to pay the deficit. A modern alternative is maybe the central bank allows real interest rate to fall or intentionally lowers real interest rates in order to reduce the government's cost of borrowing, increase fiscal space, and this way substitute for the deficit. These are two standard answers. We all understand them. In this paper, I'm going to focus on different answers. The different answer is going to be based on two key assumptions. That households are non-Ricardian. They are not your Friedman-style permanent income hypothesis guys. There are people who either have finite lives or liquidity constraints, or for other reasons, they don't have infinite horizon. This, together with the standard assumption that there's nominal rigidity, in my model, it's going to be nominal rigidity in prices, but it's going to be very similar if you have nominal rigidity in wages. We'll argue that this combination immediately gives you the possibility of self-financing of deficit. And the basic intuition is quite simple, okay? As long as, and to make concrete things, think about the government sending stimulus checks. Well, if households were Ricardian, they would think, I got the stimulus check now, but I'm going to have to pay taxes in the future, so this washes out in terms of my permanent income. But if households are non-Ricardian, they will think, okay, I got the stimulus check, and either it's going to be future generations that are going to pay the taxes, or just because I'm facing borrowing constraints, I want to consume more. So naturally, as long as you have finite lives or liquidity constraints or other classic failures of Ricardian equivalence, a stimulus check and an increase in deficit will stimulate aggregate demand. And as long as the economy's output is demand determined, the increase in demand will stimulate both output and prices. The increase in real output and real economic activity will automatically increase the tax base and will give you back more tax revenue without a hike in tax rates. In addition, if you have nominal debt, the increase in prices is going to erode the real value of public debt. So both the expansion in the tax base and the endogenous reduction in the real value of public debt will at least partially pay back for the outstanding for the initial deficit. What is going to be our main result is that this self-financing can be so powerful that can pay 100% of the initial deficit. And the key here to get that prediction is going to be the timing at which the government plans to have future tax hikes. The further in the future you push the potential tax hikes, the more you're going to stimulate agri demand. And in the limit where you push the tax hikes far, far in the future, actually you stimulate the economy so much that you never have to raise taxes in the future. That's the self-finance. As Giancarlo anticipated, there's a flip side to this, that in the same way that deficits can be self-financing, fiscal austerity can be self-defeating. And we may discuss about that at the end of the talk. Then, this is going to be our main theoretical result, and then we'll try to give you some guidance about the quantitative relevance. For that purpose, we'll explain the key assumptions and key model ingredients that drive the degree of self-financing. Most notably is going to be how quickly consumers spend. These are the intertemporal marginal propensity consumers, and the speed of fiscal adjustment. And once we discipline the theory with the relevant empirical evidence on these key ingredients, we'll argue that you get at least 50% of self-financing in realistic situations, provided that the economy is in slack. So that's going to be our main paper. That's what the paper is about. So unless there's an immediate question, then I'll start by setting up the model and taking you through the results. Okay. So what is the model? The model is going to be very close to the textbook New Keynesian model. Actually, the aggregate supply will be exactly identical as the New Keynesian model. So I want you to think about monopolistically competitive firms that can reset their prices only occasionally whenever they're hit by probabilistically by the Calvo-Ferrian that allows them to adjust prices. This, together with a competitive labor market, boils down to the New Keynesian Phillips curve that describes how inflation responds to output. So the aggregate supply side of the economy is going to be standard. The slight but consequential twist is going to be on the demand side of the economy. Instead of having infinite horizon representative age and consumer, we're going to have overlapping generations of consumer, perpetual youth consumers, as in Blanchard-Yari, with survival rate omega. So each household will survive from one period to another with probability omega, and otherwise being replaced by a new household. Now, when omega is 1, when the survival probability is 1, then you effectively have infinite horizon, so our model will nest the standard permanent income hypothesis, representative age and New Keynesian model. When omega is less than 1, the key thing is that households are going to be discounting future income and future taxes at a higher rate than the government. Why? In the literal interpretation of the model, because they're not going to be alive till that point. Okay? In more realistic account models, because they are subject to liquidity constraints, and the liquidity constraints makes them effectively discount the future because they cannot easily borrow against it. Okay? So I want to be thinking about a model nesting rank, but also giving you a very convenient representative of what the emerging heterogeneous age and New Keynesian model literature is. And this model, our key policy experiment is going to be the following. The government will run a fiscal stimulus today. In particular, it will send a lump sum transfer to all the households. So think of the lump sum transfer as the stimulus check that happened over the COVID. These lump sum transfers will be backed by future tax hikes. What are going to be the future tax hikes? The government will say, well, at some point in the future, I will raise taxes as much as needed to bring government debt back to steady state. The key policy parameter is when this will happen. So I'm going to be interested in what happens to aggregate output in the economy and the government budget as you push the fiscal adjustment further into the future. Okay. I'm going to spare you from the details of the micro foundations and jump to the aggregate consumption function that comes out of this model. And it's going to be pretty familiar from Econ 101, from undergraduate economics. Okay. So momentarily, I want you to think of omega 1, which is the infinite horizon benchmark, the permanent income hypothesis, and focus on this part of this equation, which simply tells you that consumption is a fraction 1 minus beta, that's the MPC, times what? The financial wealth that the household have, plus the expected discounted present value of their current and future disposable income, where disposable income is your income net of tax. So basically that, when omega equal 1, this is basically Friedman. Okay? Relative to this benchmark, there are two things in general that are different. One is that to the extent that real interest rates are not kept constant in steady state, then there are going to be the temporal substitution of wealth effects that will affect consumption. So in general, there's another term that tells you how real interest rates affect spending in the economy. But for most of my analysis, I'm going to be focused on a neutral monetary policy that will be stabilizing the real interest rate. So you can ignore this term and focus on how taxes and income matter. And I will do that precisely to isolate the role of the spending income multiplier, the Keynesian cross, and what government does, what the fiscal side of the economy does. The second important twist that I want you to note is this omega. So as we go from the representative age and infinite horizon, where omega 1, to lower omega, what is happening is two things. First, with a lower omega, this scalar becomes bigger. The marginal propensity to consume out of financial assets and the relevant permanent income becomes larger. Why? Because non-Ricardian households are hungry to consume fast. Okay? What else is happening is that if you look at the permanent income net of taxes, well, you're discounting future income not only by beta, and here beta I want you to think stands for the steady state interest rate, which is the interest rate, beta inverse is the steady state interest rate, which is the interest rate faced by the government. Households are discounting the future more heavily, exactly because either they're going to be non-alive at that time or because of borrowing concerns. So these are the key two features of consumption behavior that will drive our results. That you have front-loaded MPCs, you try to spend fast any liquid wealth or income you have, and you discount heavily the future. These properties are generic in the emerging class of heterogeneous engineering Keynesian models, but what we do here, instead of having to solve a big numerical black box of those models that sometimes you have to solve, we show you how a simple OLG model captures the answers that is relevant for what we're after.
Marius, you have a question from by Carlo Favero. How do we think about initial conditions here? I guess the specific, that GDP ratio in particular. I know that the model may be linearized or whatever, but what would be the way to think of that, or this later?
This is a good question. Let me just say quickly. We are setting up the model in a way that you are not allowing you to think about that question. What I mean by that, we have normalized the steady state of the economy, and we have assumed that in steady state, newborn households inherit the steady state level of the wealth in the economy. That guarantees that the steady state level of debt is indeterminate and does not affect the real interest rates. Why we do that? Because we only want to focus about the business cycle part. Okay, we want to get rid of steady state effects. More realistically, of course, you should think that the state level of debt is going to affect real interest rate. In many of our models, higher steady state level of debt increases the real interest rates. There are other questions that you want to think, such as whether it increases the probability of default. I'm just going to be abstracting from this question. Now, let me do the following so that you can immediately see how fiscal policy starts entering aggregate demand and here by airport. Well, if I use market clearing in the good markets to replace consumption with output, and if I also use market clearing in the asset market to replace private assets with government debt, then I can get this equation. This equation tells me the following. Real output in the economy is determined by aggregate demand, which is determined by two things: expectations of future income and taxes, because that's permanent income that affects spending, and of course, private wealth, which is government debt. Okay? Now, again, if households were Ricardian, they would understand that government debt here cancels out with the present discounted value of taxes. That's the Ricardian equivalence argument going back to Barrow and others. Okay? So if households are Ricardian, then government debt taxes drop out of aggregate demand and the intertemporal Keynesian cross, and fiscal policy doesn't matter. But as long as households are non-Ricardian, fiscal policy will matter. In particular, households will respond to fiscal spending to fiscal transfers by spending more and spending quickly when they are very non-Ricardian. Okay, that's the essence of the model of what we have, and that's the essence of a large class of model, of the large class of heterogeneous and new Keynesian models, or new Keynesian model with liquidity constraints. Okay, we close the model with some assumptions about fiscal and monetary policy. As I said, for a benchmark analysis, we're going to think about monetary policy that stabilizes the real rate. This is a neutral monetary policy in the following sense. The monetary policy could have raised real interest rates and lean against the real boom. That would have, of course, offset the fiscal stimulus. And if the monetary authority were to do that enough, it could kill the fiscal stimulus. So we're ruling this out to start with. What else we're ruling? We're also ruling out the opposite scenario where the monetary authority lowers the real interest rate in order to allow the cost of borrowing for the government to go down, which would have helped the government. So we're not doing either of very accommodative or very non-accommodative policy. We do this benchmark first with a constant real interest rate. More interesting turning to fiscal policy, as anticipated, we're going to be thinking of a stimulus check in period 0 of size epsilon 0, backed by tax hike at some future date h. What is h? Well, it could be next year, it could be in 4 years, and so on. For conceptual simplicity, I want you to think of our benchmark experiment as follows. Today, I give 100 million euros or dollars to the consumers. For the next 10 years, I don't adjust taxes at all. And in year 10, I adjust taxes with a big spike to bring back debt back to steady state. Why we'll do this? Because that conceptually allows you to think about H as the time of fiscal adjustment. But we'll also have a more realistic variant, which follows Leaper and the literature, that allows the fiscal adjustment to be more smooth. So instead of the tax hikes happening discontinuously on some date, they will be spread out over time. And tau D will parameterize how quickly the tax hikes happen over time. Tau Y here parameterizes how much automatic feedback you have from output to tax revenue. So I want you to be thinking of tau Y as a number around 30% or so much, which is if we raise output by 1%, how much we're going to raise tax revenue. Okay? Or to put it differently, you should be thinking about tau Y something like automatic stabilizers, how much the surplus changes during the boom.
Marius, you have two questions
Yes.
on the slides. So is the monetary stabilization rule really important for your self-financing, or you could have self-financing even if you have a standard Taylor rule, a little bit of leaning against? Is it like
very good, very good? No, as long as the monetary authority,
Giancarlo is asking this question. Sorry, I forgot to mention.
Okay. As long as the monetary authority, if the monetary authority hikes real interest rates, but not too aggressively, our result goes through. There's continuity with respect to the Taylor parameter, okay? However, if the monetary authority raises real interest rates extremely aggressively to the point that you completely stabilize inflation and output, then of course nothing can happen, okay?
And very
So
quickly, sorry.
Yes.
Very quickly, another question by Caterina Seghini. The government debt remains a risk-free asset in this in your analysis.
Correct. Risk-free asset, except first of all, there will be no risk premium, okay? But debt, you're free to think of it for the main results as if it's index real debt, in which case its value doesn't change at all. But of course, if it's nominal debt and there is an inflation surprise, that will reduce the real value of public debt, and I will allow this to happen later on. Okay. Quickly, equilibrium. I'm going to spare you from the technical details of the paper, but our model, even going back to the previous question, even though you can think of the monetary policy here being knife edge, passive active in the sense that real interest rates don't move, we actually have a unique bounded equilibrium. That's because of the non-Ricardian feature of the model. And that equilibrium is continuous, as I said, to the response of monetary policy. But again, the key thing that I want you to keep about the property of this equilibrium is the following. That as long as omega is less than 1, as long as we have non-Ricardian households, output will increase with a fiscal deficit. In particular, fiscal deficit, a stimulus check today, will increase output not only today, but also in all periods up to the tax hike. Why? Because non-Ricardian households will take the stimulus, part of it they will spend it now, but part of it they will save it, and if they save it, they will save it tomorrow, they save it after, so on. So you'll get a boom that lasts for as many periods as the till the fiscal adjustment. This boom is going to be larger if you have more non-Ricardian feature in the economy. If the MPCs are larger, you are going to get a bigger boom in each period. And more importantly, and I will explain this in a second further, this boom is going to be larger and more persistent if you push the tax hikes further in the future. Okay? So I'll explain this more, but now let me raise this question, which is the key. How much self-financing you can get because of this Keynesian boom? Okay? So to answer this question, let's first define how I'm going to measure self-finance. Okay? So we're starting in steady state, which in terms of log deviations mean initial debt is 0 in terms of log deviations. We're letting the positive deficit, and nothing else is going to happen in the economy after that exogenous initial debt. And I'm going to define new the degree of self-financing as follows. A ratio that on the denominator has to do, how much I spend in terms of the deficit, how much is the stimulus, the fiscal stimulus, the stimulus check. What's in the numerator? In the numerator, the most important part that I want to focus is this. Well, if the stimulus epsilon 0 causes an increase in output over time, I'm going to compute the net present value of the increase in output, multiply with the average tax rate in the economy with 30%, and that will tell me what is the tax-based bonanza that I get automatically from the stimulating effect on the economy of the initial stimulus check. Okay? Now, if debt is real, indexed to inflation, that will be the only source of self-finance. If debt is nominal, there will be some additional self-financing that will come from the erosion of the real value of public debt. In particular, if the same stimulus check, the same fiscal stimulus, causes a surprise in inflation and a surprise in prices, that will reduce the real value of public debt by how much? By whatever is the fraction of debt to GDP. So you're also going to get this extra boost through debt erosion that is going to be larger, the larger the debt to GDP ratio, and the larger the inflation surprise, which of course will depend on how steep the Phillips curve. But I want to be focusing primarily on the tax base first to understand that, and then elaborate on the second. Now,
Mario,
yes.
1 second, because there is a question by Olivier Blanchard that probably won't be able to stay any for the whole presentation. So I want to ask. So you want to try to understand whether since the effect depends on how much inflation is unanticipated, okay, it's something that in the long run you cannot persistently do because you form a false expectation. So he wants to you to answer this question. So
absolutely, this good. Again, this is going back to wisdom from other simple models we had about. Yeah, this is only about unanticipated stimulus checks, stimulating the economy and inflation. Of course, if you start doing systematically this, we can get to inflation traps.
Yeah.
So
you cannot do consistently do it.
We cannot do that consistently. But as I said, this channel, the inflation debt erosion channel, is there in the theory and may have been relevant in the recent context where the Phillips curve has been pretty steep. If the Phillips curve is relatively flat, then the most will come from the tax bond channel. And in our quantitative explorations, even with a steep Phillips curve, something like between 50 and 70% of the self-financing happens from the tax base. Okay, so now what is going to be our results? So of course, if you have Ricardian households, the stimulus check does not affect demand, does not affect output, does not affect inflation, nothing happens, you have no self-finance. As long as you have non-Ricardian households, you'll get some self-finance. Our main result is how this new depends on how far you push the tax hikes. And that's our main theorem, that new increases monotonically with age, as you push tax hikes, or as start defaults, which is again more slow fiscal adjustment. Delaying helps you get more self-financing, and self-financing converges to 100% as you push tax hikes far in the future. So that's the theorem, and let me explain it in 2 steps. First, I'm going to give you a visual representation of the result that will help develop intuition, and then I will actually go back in history to the static instant cross, explain the fiscal, the self-financing there, and explain how it maps to recent modern models, dynamic models.
Mario, for one second, that's mostly my question. So there is no credibility issue here that you consider.
Beautiful question.
Because the problem is that whenever you postpone, you might well lose some credibility there, okay, by postponing. So they're on my eyes, they're not equivalent to possible, policy, postponing to it smoothly.
I agree, and we get to the little bit the Pandora box of how the private sector forms expectations about the future. But let me say one thing that I think is an intriguing implication of the theory, which is as long as agents are rational, big assumption, but if agents are rational, they should understand that pushing tax hikes helps self-financing, which means you will not need tax hikes, which actually increases credibility.
I see.
Okay. So so in the theory tells you that actually by pushing, if people understand that we live in a Keynesian economy and the fiscal stimulus will indeed stimulate the economy and that will will pay back for itself largely, well, that's good for credibility. Yes, okay. That's good for credibility, okay? But if they're listening other voices that tell you, you push it in the past, hell will break, yeah, they may think otherwise. Okay, thank you. Going back to the result, to the theorem. So here's what I'm going to do in this figure. I'm going to be showing you the impulse response of output and government debt on the left and middle panel to a fiscal stimulus check that happens in period 0. And we'll see what happens to these impulse responses as I push the tax hike further into the future. Okay. So the first figure that you see here is a fiscal stimulus that happens in period 0 with a tax hike expected to occur in period 5. And what you see is that in equilibrium, output goes up initially a lot and then over time decays. To understand what is behind this impulse response of output, let me decompose it in terms of partial equilibrium effects and general equilibrium effects. What is the partial equilibrium effect? The partial equilibrium effect is that even if output in the economy will not raise, will not change, if me as a consumer get a stimulus check, and I think that with high probability, I'm not going to have to pay for the tax hikes, then I want to spend it. And I want to spread my spending between now until the tax hike happens. So in partial equilibrium, every consumer will spend more. But as every consumer spends more, aggregate income goes up, the income of everybody goes up, that makes everybody willing to spend even more. And so on. That's the Keynesian multiplier. Okay? That's a familiar Keynesian multiplier that usually we think of it as operating, traditionally we had thought about it operating within a period, but in our modern intertemporal model, it just operates, across time and within time. Okay? In particular, the Keynesian multiplier will operate between 0 and 5 here, because that's while you have the fiscal stimulus, and then we're back in steady state. Now, what is going to happen to debt with this boom? Well, because you get a boom in output and you get tax revenue, actually this may help you reduce debt before the tax hike, despite the fact that you have to pay high interest rates. Okay? So that already you start seeing how here we get some self-finance, but in this example, the self-financing is something like 20%. You still need a lot of tax hikes. Now, what if I push the fiscal consolidation further in the future to period 10? What will happen in output? Well, in partial equilibrium, consumers will now think, well, now you're pushing the tax hikes further into the future. Now I'm going to discount them even more. In partial equilibrium, I want to spend more and for more periods. In general equilibrium, that will give you a further boost to the Keynesian multiplier. So now, because of both reasons, you are going to get a bigger and more persistent boom in output, which will give you a faster and bigger reduction in debt, so more self-financed. And if you keep pushing more and more and more, what happens at the end of the day, you are going to get full self-financing. So the right figure here tells you what is the degree of self-financing as I move H, and you can see that initially it was small. Here was, I don't know, 30%. You push H, you get more. You keep pushing it, you get more and more and more. And the colors tell you the decomposition in our numerical example of how much comes through the tax base and how much comes through debt erodes. So I think the monotonicity is clear that as you push tax hikes, people discount them more. You get a bigger multiplier on top of that, so you get more self-finance. Now let me try to understand why you get 100% finance. What is the magic that makes it 100% self-finance? That lies in the theory. And for that reason, I want you to go back to static Keynesian cross for a moment, and in a second I'll give you the translation. Okay. So in a static economy, if I have a stimulus check, there are two periods: the short run and the long run. Okay? The short run is going to be static Keynesian cross. There's a stimulus check, epsilon 0, that enters consumption. What is consumption? Consumption is some multiple, the marginal propensity to consume, out of disposable income. Disposable income is income net of taxes plus the fiscal transfer. Now, if you take this consumption function, you equate output with consumption, and so for output, you're getting this simple equation for equilibrium output that simply tells you the following. If I spend epsilon 0, in partial equilibrium, that increases aggregate demand by MPC times epsilon 0. But then on top of that, there is a Keynesian multiplier that is given by what? By the slope of the Keynesian cross. What is the slope of the Keynesian cross? Is the marginal propensity to consume times 1 minus the tax rate. And intuitively, I give you $1, you spend a fraction of it, that increases income, that increases disposable income, that goes back to consumption, and we keep going on. And that's the whole equilibrium effect. So now let me ask the following: what is the tax hike in period 1? Well, the tax hike in period 1 will be, the accumulated interest on whatever was the initial deficit minus the bonanza you got because of the automatic increase in output. what is going to be the degree of self-financing is going to be this bonanza, tau y, over the deficit. If I use the equilibrium condition for y, I get this formula for immediately this formula for the degree of self-financing. And I want you to know two key properties for the equilibrium degree of self-financing in this model. The first is that this degree of self-financing is higher when the MPC is higher. Well, of course, if consumers spend a lot of what you give them in partial equilibrium, the partial equilibrium effect will be high, and the Keynesian multiplier will be high, so you'll get more self-finance. The second thing is that look at this equation and take the limit as MPC goes to 1, the marginal propensity to consume going to 1. Well, on the numerator, you'll get 1 times tau y. On the denominator, you'll get, this is 1, you'll get tau y, so you get tau y over tau y, so you get 1. So if the MPC in the static model were to converge to 1, you would get 100% self-finance. Now, in a static model, in a 1 year frequency, it would be ridiculous to think that marginal propensity to consume is 1. But what is the translation in dynamic economy? The relevant MPC in the dynamic economy is not the MPC in one period, but it's the cumulative MPC between today and when the fiscal adjustment, the tax hike, will happen. So as you push tax hikes further into the future, you are increasing the cumulative MPC because you give more time to people to spend the stimulus. And as you push the tax hike further and further in the future, well, the cumulative MPC necessarily converges to 1 because consumers will eventually spend whatever they have, okay, by optimal consumption. Okay, so that's the answer. So once you go to a dynamic model and you push the tax hikes to the future, the essence of the logic is that the cumulative MPC goes to 1. That gives you big multipliers, and that gives you full self-finance. Now, in a very important question, I gave you the answers. The theorem is a bit more complicated because the tax hikes are endogenous and other things, but that's the answer. Okay. The other thing that is very important here to realize is the following. Okay. This theoretical result is true no matter whether the MPCs are 10% or 20% in the first year. But how quickly you are going to get to this theoretical result, how quickly self-financing will happen, will critically depend on how fast consumers spend. So if we discipline the theory with the available evidence about consumption responses to fiscal transfers or consumption responses to lotteries, like the famous Norwegian evidence, we know that the cumulative MPC goes very close to 1 within 3-4 years. Okay, so the theory now tells you that you are going to get close to this theoretical benchmark pretty fast. Just postponing tax hikes to 4 years, let's say, will give you a degree of self-financing that may be in the range of 80-90%. That's the essence, and I describe the result so far focusing on the tax-based channel. So that result would have been true even if prices were fully rigid, or even if debt was indexed and it's real. Okay. Now, what happens if instead we are in a realistic world where debt is nominal and prices are somewhat flexible? Then the response in inflation will be pinned down by the Phillips curve. Using the textbook New Keynesian Phillips curve, which is not the most realistic, but will allow me to give you a sharp result. Okay? We know that the innovation in inflation is going to be equal to kappa times the innovation in the net present value of output. But now note, the debt erosion depends on the innovation in inflation, which is proportional to the net present value of output. The tax base, bonanza, is itself proportional to the increase in the NPV of output. So all you have now is that going from a situation where everything was going through the tax, all the self-financing was channeled through tax-based expansion. Now, part of it is channeled through debt erosion, but the two things are proportional to each other. And what determines the relative contribution of the debt erosion versus to tax base Well, the parameter that you should expect, if tau y, if the automatic feedback from real economic activity to surplus is bigger, then the tax-based standard is going to be more important. If the slope of the Phillips curve is very high, or the debt to GDP ratio is high, then there will be more scope for debt erosion. Okay, so the slope of the automatic stabilizer in surpluses, together with the slope of the Phillips curve and the government to GDP ratio, will tell you how much of this self-financing will go through the one side or the other, but you're still going to have full self-financing as you push tax hikes further in the future. And that sort of summarizes the main results. Now I'll very quickly tell you like some extensions and the quantification. This goes back to some of the questions that were already there. First, how sensitive our result is to using this simple OLG model. I'll redirect you to our paper for details, but the basic answer is the following: is generic within the class of incomplete not incomplete information. That's my other agenda of heterogeneous new Keynesian models with incomplete markets with liquidity constraints or finite lives. You always get it. What will discipline the degree of self-financing is not the details of the macro foundations, but rather the key question of how high MPCs are and how quickly consumers spend. So different models that have different macro factors but give you the same MPCs, they will also give you the same predictions in terms of self-financing. Paris extensions, investment, government spending, I'm not going to go through them. Key that was raised in the beginning, and I want just to repeat it, that the result extends to more general monetary policy. There is a threshold 5 bar for the slope of the Taylor rule. That threshold is positive, such that below that you get full self-financing. If monetary policy is sufficiently aggressive, then the degree of self-financing will be less than 100%. If the monetary authority is so hawkish that it replicates natural flexi price allocation, completely stabilizes inflation output, then of course nothing will happen. So we see the result as being practically relevant in what context? In the context of depressed economies with a slack economic activity, where the Phillips curve is relatively flat, so monetary authority may not react much, either because there's not enough inflationary pressure, or because it wants to allow the economy to boom. So in those situations, the Keynesian boom is likely to go through, and in those situations, self-financing is going to be likely to be large. So the last slide is going to be a quantitative evaluation. So what am I going to do now? Okay, I tell you the theory. I told you it's generic. Let me try to write a richer model. The richer model will be an extension of our LG model that will allow to capture not only the spending behavior over time, the intertemporal MPCs, but would also potentially heterogeneity in MPCs across households and potential wealth heterogeneity. So we'll do that in 2 steps. We're going to have first an extension of LG version of our model with hand-to-mouth consumers, and we'll also have a fully fledged Hank model, a Yagari model with all the bells and whistles. We're going to calibrate aggregated band parameters, in particular the steady state discount rate to the steady state interest rate, and the parameters that determine the MPCs to the available evidence about marginal propensity to consume. For fiscal adjustment, we're going to discipline the speed of fiscal adjustment by the available evidence, empirical evidence of how, at least historically, fiscal adjustment has happened, which is it happens, but it happens low. And finally, we'll discipline the nominal rigidity, the slope of the Phillips curve, by the available evidence of the Phillips curve. And what I'm going to show you, we're going to have a relatively flat Phillips curve, so maybe this is more relevant for the beginning of COVID, but the results don't change much with a much steeper Phillips curve. The bottom line I want you to take is what I was saying before. Even if these are, again, the impulse responses of the quantitative model for output and debt as you move the tax hikes in the future, even if you were to move the tax hike just for 12 quarters, 3 years, you're about 50% self-financing. You go to 25 quarters, what is this? 6 years, whatever, you get 80%. So quantitatively, the degree of self-finance may be very large. So I'll conclude here and leave some minutes for discussion. And I think I'm not too bad with the timing, correct? So main takeaway, as long as the economy is in slack, far away from capacity constraints, and monetary policy does not hike real interest rates too much, deficits can largely pay for themselves. These are robust implications of a large class of models, basically any realistic new Keynesian model. The speed through which this will happen depends crucially on how severe the liquidity frictions are and how large the MPCs are, especially in the short run. There are two channels, the tax-based channel that I emphasize, but also debt erosion. The second channel is more topical because of inflation. Converse of the result is the following, that if you were to do a tax hike early on and try to do austerity early on, by depressing demand in the economy and depressing the real output in the economy, you could end up getting a reduction in the surplus despite the initial tax hike, and end up in a situation that it's completely self-defeating. You did your austerity and you're back to the same level of steady state as before.
In this case, you would like not to last long, right? It's the opposite of delaying. Instead of having the tax hike, the logic of the would tell you that you want to, maybe you want to do austerity today, but just promising tomorrow.
Yes, that would help. Yeah. Correct.
You will read it the other way around.
Be very German now and extremely Keynesian next year. Ongoing work. I think there are interesting implications for inflation that I could talk about if you wish, about how much inflation these models generate and how they compare to the fiscal theory price level. Obvious question, I only did positive analysis here. I didn't tell you whether it's good or bad to get self-financing. Also did a closed economy. A lot of this fiscal stimulus could spill over to other economies or be lost in other economies if you're in an open economy. And I disciplined the theory with the available macroeconomic evidence on MPCs and the available evidence on the slope of the Phillips curve and the like, but not the direct evidence on fiscal multipliers. For that, I will not say the key thing here is the cumulative fiscal multiplier and how this varies with the horizon of fiscal adjustment. Unfortunately, the evidence, the direct evidence on that kind of question is scant, but it will be an important empirical question and important question also for the theory. So I'll conclude here.
So why don't we very quickly, there are two questions coming up during your discussion, whether the content, so if you look at spending, the content of spending, like investment, this is actually a question that is intellectually interesting, but also pretty much topical because of this, intense discussion about investing in innovation. So one question is, how would you think about the kind of spending in this model? And the other question is more, I guess, academic, which is there aspect of the theory it would be interesting to test what can provide some evidence that
how could you test it?
Component of your model could have empirical support, like the delay, or of course it's difficult.
Yeah. Let me start with the second question, which is a bit easy to answer, but I don't have a direct answer. Well, the key prediction of the theory, which is testable, is that the fiscal multiplier, the cumulative fiscal multiplier, increases as you have more slow fiscal adjustment. So if in the data we had variation, not only in terms of how big the stimulus is, or whether it happens in a slack or not, but also on how quickly it's backed by tax hikes, or in particular whether fiscal stimulus happens with a promise to consolidate the budget fast, or with it's unbacked by such promises, then the prediction of the theory is that unbacked stimulus should be more stimulating than stimuli that are backed by fast consolidation. I don't know of any direct empirical evidence about that, but it also stands to logic that, of course, if you were to give a stimulus check to people now and take it back in a year, probably that will not affect that much aggregate demand. And there is evidence from the post-COVID that the very fact that we gave the stimulus checks, but we didn't take them back quickly, allowed wealth initially to go up, but then to be spent later on. So those predictions about the dynamics, there are hints about it in the evidence, but a clear-cut test. I push the tax hike, I get bigger multiplier. It's not available, and nothing about it. Going back to now I forgot the first question. I'm sorry.
Oh, the investment.
Investment.
Yeah, the investment. Thank you. Sorry. The investment. That's a good question, and it's a little bit tricky. I will say first the following. There's a benchmark that we analyze in the paper that makes irrelevant kind of investment kind of irrelevant. If you maintain the assumptions that firms are operating on the complete market, they're not private firms with net worth, okay? They're firms with complete markets. And they do not themselves engage in saving, accumulation of cash reserves or net worth, then they basically drop out of the model in the following sense. The Keynesian cross that determines consumption and the feedback of household stimulus to consumption, thereby to output, is the same whether you have firms or not. And investment only shows up in the effective Phillips curve from consumer spending to inflation, because more consumer spending will also give you more income and more output, which will give you more inflation. So qualitatively, the result doesn't change with investment under the assumption that I said complete market firms. Quantitatively, the split between debt erosion and tax-based matters. For the realistic now case where firms are subject to incomplete markets, they are entrepreneurs, then you start having an analogy between the marginal propensity to consume and the marginal propensity to invest out of stimulus to the firms, okay? So we haven't solved that, but I think that will be the realistic case, and then we need to start thinking about MPCs and MPIs if you want. I think qualitatively the mechanism would go through, but again, if you now ask, how different it is to stimulate the household sector versus the firm sector, we have to think about this MPI versus MPCs.
Very good. I mean, it's always difficult to go from theory to policy without enough thinking. When you like to reflect on the model, what the model really. One thing that puzzled me is the fact that, correct me if I'm wrong, in the austerity interpretation, the other way around, is this model going a little bit against the conventional wisdom that you want consolidation to be stretched over time? No, in a sense, there is always this idea that the consolidation may be harsh if become a cash cow generating, like in the
yes,
like,
or the tax smoothing logic as well.
There are many public finance reasons for that. Here, in terms of multiplier and effect on output, unless I'm reading wrongly, there is an anti. So you would like to do it more quickly, no, for the multiplier. Am I wrong?
So
or
again,
something that they're missing. That if you stretch it to over time, may actually create more quote unquote output losses or demand losses. But I may be wrong because
No, you're right. So first, going back to you raised a related question before. Here, fiscal austerity would be less self-defeating if you do a tax hike now and the tax cut tomorrow. Okay. So of course, if instead of tomorrow having a tax cut, you have another tax hike,
Yeah.
okay, that will accumulate, okay? Now, if you want to have the following is still, however, going to be true. If I do a tax hike of 10% today and 0 nothing versus 5% today and 5% tomorrow, the second, I have to think whether the second is going to be worse or better. That I need to think. I'm not ready to
It's
answer.
an important question, no? Because
It's important. It's yeah.
I don't like I don't like the word austerity because it's associated with the push of a crisis. No, you need to generate cash.
True.
I mean, the idea is
but
more
one more thing
in the field of understanding path and consolidation. Sorry, go ahead.
Correct. But the other thing that you're indirectly raising with this question is the following. There are a lot of intuitions we have about taxes and austerity that work through the supply side of the economy.
Yeah.
Starting with tax smoothing, starting with distortions on the production side, incentives to firms and investment. Okay, all these are about the supply side. Basically, here what I've done is I shut down anything that's on the supply side and isolated the demand side. Okay, and the truth is that, in my view, the models we have are not very good in smooth pacing between the two views. Okay, so if I want to think about the short run, I want to use the Keynesian model, and then I'm ignoring the supply side effects largely. And if I want to think about the long run, then I'm forgetting the new Keynesian model, do flexible prices, and then it's all the supply side. But our models don't smooth pace very well, and that's where I struggle myself. To come up, when should I trust more the one type of prediction than the other? My gut feeling, if we're talking about the business cycle, I want to think about Keynesian multipliers. But if I wanted to think about what was happening to Greece and what Greece should have happened in the long run, I'm happy to, realize that I need to take a hit in the short run through a demand channel in order to make the steady state much better, hopefully. So I would leave it there.
We have many questions coming in. For example, one by Francesco Molteni about consumer agents' belief. Now, the possibility also of self-fulfilling prophecies once you get a coordination problem. Those are no area that you're not unfamiliar with. But
yes.
So
absolutely.
This is one question. The other question, if coming back to the non-linearity coming from the initial condition with the level of the GDP. Those are the two questions that just came in.
Good. Okay. So for the beliefs and self-fulfillment, of course, I'm very sympathetic. I'd say this is especially relevant in the Keynesian framework because at least as long as real rates don't move much and the central bank does not try to offset the booms, you can start having almost self-fulfilling booms. If I expect everybody to spend more, I have more income, I want to spend more, okay? And the multiplier I've been talking to the extreme could potentially open the door to multiple equilibria. That said, one property of Hunt models and of realism is that consumers think a lot about the short run as opposed to the very long run. So I think it's maybe a bit easier to think that all that matters then in the short run is what fiscal policy and monetary policy does in the long run. And beliefs about the long run are not going to drive that much aggregate demand in the short run. Now, what happens in the long run? Again, I think for the long run, we need to leave the Keynesian model and go back to flexible price models.
I apologize for those who asked the question. I was short because we are a little bit out of time, but I think
because there was another question, but I don't think we have time to also to address the last question by Caterina. Very sorry.
Okay, so any last thought you want to share with us, Marius, on this? It's a research project, no? Like I think Olivier Blanchard rightly so thought that it was actually something important to.
We think so, and you know, to tell you the truth, we're also somewhat.
There could be more on this.
Yeah. No, as I said, we see our paper more giving you guidance on what determines the degree of self-financing, not necessarily not a panacea that you'll get self-financing always. And you know, I think going back to, you know, I was partly motivated by what was happening with fiscal austerity in Europe. You know, sometimes we guide policy more from the supply side, and we sort of forget a bit the demand side. Of course, you know, the IMF policymakers cared a lot about the short run and how austerity could cause a recession. I hope from our result you see the extra layer that those recessions can be largely self-defeating. So you have to be very careful how you do the austerity. It's more important, going back a little bit to what Giancarlo, it's very important to put the economy in a path of fiscal consolidation in the long run without doing it too fast in the short run, and without, especially if the economy is already in a slack. So I hope this informs policy.
Yeah, I'm sure there will be more work on this line of research, if anything, because policy questions are all there for us. And as we say, is the question of the day, meaning every day for this future. So, Laura, would you like?
No, in fact, I would say that Caterina was asking for the second question, whether you have some nonlinearity in the ability of self-financing whenever you have a high debt to a GDP ratio, so whether it depends non-linearly in your ability. So that was the question that we missed in some way.
Correct. In the model presented, actually goes a bit in the opposite way, in the following sense. If you have more steady state level of debt, you get more debt erosion with less inflation, which will alleviate the pressure on the central bank to raise real interest rates.
Yeah.
However, there's another channel that I would immediately think, which is if you're in an economy with high debt, raising deficits will increase real interest rates, and that could backfire. I think,
of course,
exactly. So that's the kind of nonlinearity I think it could hurt self-financing. Exactly.
Yeah. Thanks a lot. Well, I'm happy that you were able also to answer to Caterina's question. Great.
Good. So thank you everybody for participating. Thank you, Marius. Hopefully.
Thank you, Marius. Thanks.
Thank you very much for having me. Thank you.
Thanks.
It was good to see you again.
The next webinar will be November 5th. Will be announced through the usual channel.
Yeah.
On the debt agency, not the European management agency. Okay.
So we wait for you in the audience, Marius.
It's going to be election day, right?
Yeah, I know. So we will be both looking one side or the other. Yeah.
I will be in the US actually waiting for that. So I'll participate.
Yeah.
Okay.
Thank you very much again.
Thank you, Marius. Bye-bye.